presenters, chairs, discussants, and all participants to session 1B on sustainable finance, something that's proving to be a major pivot point in the history of finance. Before we begin the session, allow me to walk you through the guidelines. A total of 15 minutes will be allotted for paper presentation, upon completion of which a bell will be rung. Post this, 2 minutes will be allotted for presenters to conclude. This will be followed by 7 to 8 minutes of discussant remarks with an additional 5-minute slot for questions and answers. This session will be chaired by Professor Parag Kalkar and Dr. Pradiptarathi Panda as the discussant. I would now like to request our Honorable Chair, Dr. Professor Parag Kalkar, to kindly take the session forward.
I request the first participant to start the presentation, and all the audience who are present here can jot down their questions, if any, and then at the end of the session, we'll request you to ask the questions. Jianing, Jin.
Yeah,
Zhang.
I'm here.
Are you there?
Yes, could you hear me?
No. We can hear you, but we can't see you.
Okay.
Yes, yeah. You can start your presentation. Ready?
Oh, okay. Hello, everyone. I'm Jing from China-Jiongye University, and today my topic is the stock performance of green bonds issuers during COVID-19, and I only focus on China market. So first, what is green bond? Actually, green bond is financial products for supporting projects with environmental benefits, and with the growing attention of concept of CSR and green, the green bond market is rapidly growing since 2014, and especially China has the biggest market so far. And since the green bond issuance is kind of CSR practice, so the insurance corporate can.
Did you have a PPT to share? If you can share the PPT, you have a PowerPoint presentation to share?
Yes, but
you can share.
I'm not allowed to share my screen.
1 minute, 1 moment, please. Allowed to share multiple.
Try now. Try now.
You can try now.
Oh, yes.
Yeah, please. Make it full screen. Please go ahead.
See? Is that okay?
Yeah, it's visible.
Yeah, and corporate issuers can build positive public perception, and they should bear a considerable reputation risk if they cannot meet the requirements and their promise. So my research idea is come out with that. I want to explore whether the issuance of green bonds can mitigate the crisis like COVID-19 impact on Chinese firms' stock return. So here is some key literature review. Many researchers have found that CSR practice can help firms to grow their stock returns. Especially links find high CSR firms can obtain more trust and stock returns even during the financial crisis. And Tang and Zhang point out the issuance of green bond, which is a kind of CSR practice, can positively affect firms' stock prices. And under the background of COVID-19, He find industries related to pharmacy, IT, and agriculture have the resilience to COVID-19. And also, E funds the COVID-19 actually will shock the Chinese green financing. Based on the positive effect of CSR practice to corporates, so my first hypothesis is Chinese corporation that issue green bonds have positive abnormal stock return during the COVID-19. But to consider the shock effect from COVID-19 in most industries, so my second hypothesis is Chinese financial corporates that issue green bonds have negative stock performance during the COVID-19. My key data is mainly from CSMAR and the WIND database. Both of them are Chinese financial database. And the first one, I get all green bond sample from 2016 to 2019 issued, and I selected filter these issuers and get the issuer corporate daily stock return and CSI Chinese market stock return index. The sample period is from 2019 March 11 to 2020 April 10th. The paper is mainly use event study method to measure the impact of COVID-19. So I selected two event dates. First is 2019 December 31st, which when the COVID-19 there is first official news for COVID-19 outbreaks in Wuhan, China announced. And the second day is 2020 March 12th, when the COVID-19 passed its peak. And the event window I set is 10 days before and after event days. And the estimation window is between 200 days before and 20 days before the event date. And I utilize market model in the event study to use the market index and market return to estimate the expected return, and the difference between real return and expected return is abnormal return. And I will mainly focus on the CAR, which is sum of AR. So first we look at these two figures. We can see here is a fluctuating upward trend among these two event dates. And more detailedly, we can see here is very small and a positive effect on the announcement date. But here is a significant and a large effect after the announcement date. Since different industry may have different impact from the COVID-19, so I mainly divided the issuers to financial institution and non-financial institutions. So the results show that the non-financial institutions may have a better stock return performance than financial institutions. And to better test the result, I also use Pharma French three-factor model to test the result. And for the first event date, the results show it's different from the market model. Here show that non-financial institutions actually have negative market return, and financial institutions have positive and large significant CARs, which is better than non-financial issuers. But the similarity is financial institutions have small positive effect CARs, on the announcement date, which says that actually financial institution is have very small impact from the COVID-19. On the second date, second event date, here is a very similar result from the market model, actually. There is small positive cars on announcement date, and the non-financial institution have positive significant cars, which is better than financial institution. So my conclusion is, first, here is a very small positive early impact of COVID-19 on financial green bond issuers stock return at announcement date, which is event day, I select. And after the COVID-19 passed its peak, non-financial firms have better performance. They have significant abnormal stock return, while financial issuers have negative abnormal returns. And also I found some limitations in my research. First, cause I only focused on Chinese stock market, so the sample of green bond issuer companies is relatively small. And second limitation is I only use 2 models to estimate the abnormal returns, which is Farmer French 3-fact model and market model. So that's all my presentation. Thank you. Should I stop sharing my screen?
Yeah, please.
Okay, so thank you, Jill. You have taken a very emerging topic, and green bond is now popular in all over the world, and many countries are trying to adopt green bond, and China is one of the largest green bond market. I enjoyed your paper reading, and you have set your hypothesis like how green bond whether green bond has positive abnormal stock returns during COVID-19, and the second hypothesis was on financial corporation that issued green bond have a negative stock performance or not, and you have considered 2016-19, and the COVID period also you have considered from 2019 to 2020. The methodology you have used event study, market model, and Farmer French models, and overall you have found that there is a small positive early impact of the COVID-19 on financial green bond issuers stock returns at the announcement day. And after epidemic passes, it peak and non-financial firms have better performance, and non-financial green bond issuers have significant abnormal stock returns, while financial issuers have negative abnormal returns. And you have done extensive study on the front of methodology, and you have considered a good market as well. I have few comments. You can see on the objective, you have considered the green bond of China market. But when you have considered for analysis, you are considering the performance on equity market. So what is the impact of on the performance of green bond? You have to mention, because you are silent about that to the issuer and to the investors, whether that green bond itself is impacting or attracting more investors or not, that you need to examine. Second is the size of green bond you have written nicely. You have compared with the world green bond markets. But what is the size of green bond of China? Am I audible? Okay, so the size of green bond, that issue has been given, but what about the trading volume of green bond? Actually, there are lots of issues over here in green bond. First issue is the fund raising by the issuer is more costly in the green bond as compared to your brown bond or blue bond, what you say, other category of bond. And what is the trading volume and value of that green bond? You need to mention. What is the yield that green bond has provided, and what about the coupon and the cost of issuing the green bond? The transaction cost is missing. You have considered in data front only equity data, and why you have not considered data till 2021? You have considered 4 months, I hope 3 months during COVID, and you are mentioning that you have done analysis considering COVID period. But COVID has a longer period to do. You have only considered the initial 3-4 months. Thereafter, in the methodological front, you have also reviewed some of the articles on connectedness among the markets. Here, yes, the review was very nicely organized. However, you have not used those models, or you have not analyzed any connectedness. So either you can remove those connectedness papers from your review part, or you should apply connectedness models like multivariate Garth model or Diebold and Yilmaz spillover model. Or now connectedness networks has been developed, and many ABDC papers are mentioning these networks for connectedness. Then the study could have also used buy and hold return that you are not mentioning. You have not done. Only you have done the cumulative abnormal return through event study. Further, the conclusion, in the conclusion front, you need more clarification whether COVID has resulted in higher abnormal return, because we have seen all the markets has bounced back like anything after the COVID period, after 2-3 months of downfall. Or green bond issue has given higher abnormal return to these markets, these equity returns that you have considered. And who are beneficiary of your study? You are silent about that. Who will get benefit, either investor, issuer, or intermediaries, or regulators? Now the scope you can extend for the possible publication in ABDC. You can do one cross-country analysis. Only China considering may not give you proper justification or generalization of how green bond works or how green bond performs. You can consider other countries like USA, France, Sweden, South Africa, and Japan, who are in top, who are the top issuer of green bonds. Okay, so that's all from my side. Thank you. Sorry, you can open for close discussion. And
if she has some comment, yes, on this, whatever Panda sir has shared his thought process.
Jin, you are there?
Oh, yes.
Yes.
Do you have any comment?
I hear that said I didn't mention some features of green bond because I only want to focus on how the green bond issuance affect the actually investors' sensitivity to the green bond, and how they conference do some CSR practice, how the investor to respond it. So I didn't mention some green bond features. I only focus on they did that action. So yeah.
Yeah, now the forum is open. Anybody from the audience, just you mention your name and then you can ask.
What?
I think you can read out the questions.
When you mentioned it is green bond, is this issued by non-financial institutions to Chinese companies finance or other firms outside of India? Is the
Your
first
voice
question.
is yeah, coming.
I only focus on Chinese market. May I ask you a question?
You need me to repeat it?
I don't hear clearly. Sorry.
Do you need me to repeat the question?
Yeah, please.
When you mentioned it is green bond, is this issued by non-financial institutions to Chinese companies to raise finance only or even for firms outside of China?
I only focus on Chinese market, not outside of China.
All right, thank you.
Yeah.
That's all the questions.
Anybody from audience?
The floor is open for questions. We have a question here.
I have one question. Am I audible? I have one question. Am I audible?
Are you able to listen to the question?
What? I didn't hear the question.
Yeah, am I audible now?
What?
Yeah. So in your conclusion, actually in your result finding, there is a only small positive impact of this COVID-19 on abnormal returns. That may be because of the rebounds of the markets, not because of the issue of the bond issuers, green bond issuers. How do you control that?
I don't really understand the question. Are you mean the?
Please go to your finding.
So the question is whether you have segregated COVID and bond equity return separately, whether bond issue that I have raised, whether green bond issue has resulted higher return or COVID has resulted higher equity returns. So you got high abnormal return of the companies which have issued green bond, right? What is the cause of this high abnormal return?
Is it because of the COVID-19 rebalancing of the market or because of only the issuance of green bond? How do you deal with it?
If without the COVID-19 background, the green bond issuance actually have a positive effect in other research. Here is obvious positive effect if the company issues a green bond, even outside of China. So I want to explore the new field. So I based on the background of COVID-19 and to find if COVID-19 will influence this kind of positive relationship. That's my answer.
Anyone else?
And one more, while studying the event study methodology, the researcher should be neutral while formulating the hypothesis. Directly written the null hypothesis that positive impact or positive effect. So, being a researcher, you should be neutral in framing the hypothesis. especially in the event studies, whether that event may create positive or negative, that should drawn from your results, not before.
So you mean my hypothesis is not consistent with my my results?
Your null hypothesis should be there is no effect, and your alternate should be there is an effect. So you can't determine, like predetermine whether it's a positive effect or negative effect. That's what.
Yeah, the researcher should be neutral.
It should be no effect. Like the null hypothesis should be no effect.
It should be neutral while conducting the event study, especially while formulating the or while writing the hypothesis.
Like if you know that it's a positive effect, then there's no point in testing.
Yeah, but the conclusion, my result found it actually have it has impact on the stock return, but it's not very large, but it did have influence. So my hypothesis, I write it has impact the return.
Okay, thank you, Jane. Thank you for your presentation and then question answer session. Thank you.
Thank you.
Garima Sisodia is there. Anybody from Rajagiri Business School? Yeah, Anto is speaking.
Okay, Anto, yes, we are here. Am I audible?
Yeah, please start your video. Yeah.
Okay.
Introduce yourself.
Yeah, I'm Anto Joseph from Rajagiri Business School. I'm an assistant professor over here with the finance department. And we three others are there. We are going to jointly present the paper. So could you please allow me to share my PPT?
Just a moment. Can you try?
You can try, it will work.
Yeah. Is it visible?
Yeah, it's visible.
Okay, thank you.
So your time starts now. You can start.
A very warm good afternoon, all of you, the respected session chair, the discussant, and other conference participant. The title of the paper we are going to discuss is whether the corporate green bond act as an armor during the crisis, evidence from a natural experiment. So the three presenters are Garima Sisodia, Anto Joseph, and James Dominic. The flow of the presentation will be in this order: introduction, followed by motivation, then literature review, identifying the research gap, then research objective and hypothesis formulation, research model, followed by result and discussion, then conclusion and implications of the study. As we all know that in the year 2008, World Bank came with the first green bond issuance. And after 12 to 13 years, if you look back, the recent past, there is a phenomenal growth in the green bond issuance, both in terms of number of green bond issuance and at the same time, the size of the green bond issuance. Now, what will be the reason behind such a tremendous growth? Our paper is actually examining that. So why do companies go for green bond rather than the conventional bond or brown bond? At the same time, whenever a company is going for issuing green bond, is it actually enhancing the green image of the company and thus the valuation? And whenever we talk about a crisis, what is actually differentiating a green bond from a brown bond firm? And during a crisis, what is the value erosion happening with a green bond firm and at the same time a conventional bond firm? And at the same time, the resilience and recovery, which company is in a better position to recover fast? The speed of the resilience is with which company, which one is having yes, more speed over there. So we would like to ask these fundamental questions, and our paper explores to get the answer for these questions. So coming to, I mean, you can see from the picture, there is an overlap and interlinkage between social bonds, sustainable bond, and green bond. But whenever we come to the definition of green bond, so green bond is a bond instrument. The entire proceeds of such an instrument is going exclusively for financing the green projects. So that actually differentiates a green bond. And we all know that it is well known in the external literature also. A better ESG score is actually helping a company to have a significant and positive relationship between the financial performance and value of the firm. So whenever a company is going for issuing a green bond, that is actually giving a very good positive signal to the market that the firm is ready for its environmental commitment. And nowadays we talk a lot about impact investing, and at the same time, most of the investors are very, very environmentally sensitive. For such investors, such as signals are very, very relevant. And at the same time, the proceeds of the green bonds, which are exclusively going for green projects, and it has to be there and properly announced and shown in the prospects. So this will give more transparency, and this will reduce the information asymmetry. So nowadays, investors really, especially the environmentally sensitive investors, really want the full set of information about the green projects. So, but this type of announcement and declaration is not with the brown bonds generally. And at the same time, if you look at the stakeholders approach theory also, whenever a firm is showing more commitment to the environment, and whenever they show more accountability to the environment, they are in a better position to enhance the value, because they are very responsible to all the stakeholders. They are in a position to safeguard the interest of all the stakeholders. So this type of a green image developed by showing a positive attitude towards the environmental commitment by issuing green bond, which will enhance the green image of the company, and this will lead to a less valuation and a very good recovery whenever there is a crisis. So our paper is exclusively going to focus on a crisis period and how the green image through green bond issuance is helping a company, whether it is acting as a protective shield to the company or not. So coming to the motivation, we would like to focus on the World Bank Treasury Report 2018. There they clearly said that the intensity of the environmental shock nowadays, and we are the last generation to change this, such a shock we have given to the environment. For that, massive investment is required, and green bond is such an initiative towards that. This slide is what I was talking about in the beginning, such a phenomenal growth. If you look at 2019 onwards, 2018 it was around 400 issuance, 2019 it was more than 800 issuance, and it is growing tremendously. And 2021 we have data up to the first half of the year. We have already crossed 76% of the last year. So what is the reason behind that? At the same time, earlier, the climate risk, it was mainly leading towards business risk. Now, this is a financial risk also, because most of the investors are very sensitive before they invest in a company. Suppose if you are inclined more towards ESG, environmental, social, and governance, and if you have a good score, investors are ready to provide their funds. But a firm is having less score, which means the cost of capital is also going to increase. Literature review, I'm not going to focus too much on that due to the lack of time, but these are the main focus. Actually, a few of the papers, just theoretically, they explain about green bond and their significance, the growth of the market, all those things. Many of the papers are focusing more on impact investing and environment sensitive investors and the ESG also. Then a few of the papers clearly says that it is reducing the information asymmetry. So more investors are more inclined towards such firms which is having an commitment towards environment. And there is a positive association between environmental responsibility and stock market performance, and CSR is also linked with this. So coming to the research gap, objective and hypothesis, what we have seen, there are only very few studies which look at the green bond issuance and corporate performance and value. And we couldn't find, to the best of our knowledge, a study which explore the value, valuation, recovery, and resilience during a crisis. So we have taken COVID-19 as a crisis period, and we check how the issuance of green bond is actually helping FM. And at the same time, another thing, most of the past papers, they didn't take care of the endogeneity issue. FM may be having high value, due to that they may be going for more social commitment or vice versa. So that is one of the major problem, theoretical problem over there they didn't consider. So we are taking care of that by taking COVID-19 as a natural experiment or a natural setting. So that these are the three main objectives of our study: to examine whether the green bond issuance enjoy higher valuation than brown bond firm, to examine whether green bond firms experience lower value erosion during peak of crisis, to examine whether green bond firms experience high resilience in recovery period of crisis. And the hypothesis we formulated are green bond firms are valued more by investors as compared to brown bond firm. Green bond firms face lower value erosion compared to brown bond firm during crisis. And the third one, green bond firms are more resilient compared to brown bond firm post-crisis period. Okay, so the rest of the presentation, my co-president will continue.
Good afternoon, everybody. I hope I'm clearly audible.
Yes.
Yes, ma'am. So I will continue with first how we selected the sample for our study. As we can see here, the firms which have issued green bond are concentrated on 6 countries. The 6 countries represent 70% of the total green bond issues in terms of numbers, and around 80% of the green bond issues in terms of value. So we chose these 6 countries as our sample, and we have collected data on all the companies which have issued bond. With that, we come to a list of 6,246 firms, out of which listed firms were only 2,246, and ultimately we could find only 90 firms which had issued green bond. We wanted to eliminate the size effect which would emerge because the proportion of firms which have issued green bond is very, very low. So we also run a propensity score matching to have equal number of firms which represent the green bond firms and the brown bond firms. So ultimately we have 180 firms which becomes our final sample. Coming to the time period, as we had multiple countries and not each country is affected in the same way by COVID-19, we have taken care of defining the period where they would be affected by COVID-19, and we have divided into 2 parts rather, COVID-19 peak and COVID-19 recovery. Now, COVID-19 peak is defined as a period between the day when COVID-19 case was first discovered in that country and the point at which, or the day on which the main index of the country has hit its lowest point, which was mostly March, towards the end of the March for all the countries. But the recovery period, if you see, this is the point we're trying to find out where the main index has bounced back to the pre-COVID level when the first case of COVID was detected. And here we can find country like Japan had taken considerably longer time. France has recovered comparatively faster. All the data has been collected from Thomson Reuters data stream, which is a very reliable source for data. These are the base models for our research. So the main question which we had, which we wanted to address was, do the firms which issue green bond have better or higher firm value or not? So for that, we have taken Tobin's Q as a proxy for firm value, and green dummy is our main variable of interest. We have included a set of variables for control, which included firm specific variable, 3 industry specific variable, which is environmental innovation, resource usage, and emission. All these three are, as the data which we find on the companies are many times missing, we have converted into industry specific variable. So we found out what is the average for each industry, and then we looked into if the company industry has, we have looked into the average values, and we have then find out that industry is having higher commitment towards environmental innovation, resource usage, and lower emissions or not, and accordingly dummy variables have been assigned to them. Now, once we find out if the value of the firms are higher for the green bond firms, then we would like to know why this value has been higher. So we have two channels through which the value creation can be there, value erosion and resilience, as already defined by my co-author. So only two new things which have been added here is the government stringency index for COVID, because that is what has actually led to value erosion, because the companies had to be put on halt on their production things. And also one more thing, which is environmental policy and stringency index of the country, because we are having different countries and not all countries treat the environmental issues in the same way. We wanted to make sure that the model is free from different issues. So we have looked into the indigeneity issue, which is caused whenever we say sustainable practices is something which is adopted by firms which have higher value and higher profits. At the same time, sustainable practice leads to higher value and profitability. So there's an indigeneity issue. We have taken the natural experiment method as COVID-19 to overcome it. And we have run a propensity score matching technique to remove the size impact. So as we can see in the graph, the first graph is before the propensity score matching has been applied, and the second one is after. So we can see the balance between the brown farms, which is untreated sample, and the treated sample green farms is very much into place. These are the basic descriptors put into a graph. We can see that green farms enjoy higher value. They have higher liquidity, they are bigger in size, and they have more commitment towards the environmental practices through better resource usage, lower emissions, and higher environmental innovations. Coming to the main results, as we can see here, the green dummy is significant in all the models. We have different models. We kept on adding. First, we had only univariate model where green dummy was there. Then we added control variable related to firm, then industry, and then country specific. So we found in all the models, the green dummy was significant, which means green bond firms enjoy higher value compared to brown bond firms. And if you look into the industry effect, the companies which are coming from the industry, which have higher commitment, enjoy higher values. If you look into the impact of the environmental policy and stringency index, so we can see that actually it creates more of burden on the firms to get green certification as well as to maintain green certification. So rather than promoting, as of now, we feel as per our data that the policies which are in place are actually being more strenuous towards the companies which are trying to adopt green practices. The complete model also is in the same line, and VIF score shows that we do not have an indigeneity issue. Coming to the value erosion, which we are looking into during peak period, did the fall was less for the green bond firm? We found that green dummy is positive once again for all the models. If you look into the impact of the industry which they are coming from, if the industry has high environmental innovation, there is a positive impact on the returns during the peak period. And if the emissions are lower for the industry, that is also helping, although the resource usage does not come out to be significant. And we also introduced one more variable here, which was government stringency index for COVID-19, which shows how strict was the government to impose the restrictions to arrest the spread of COVID-19. And we can see both had a negative impact on the return as expected. VIF score once again show there is no problem of multiplicity. The last table.
You have to wind up now. Your time is getting over.
Yes, last table, which is for resilience, even though effect is less. But yes, to some extent, there has been advantage of adopting green practices, which is reflected through or which is proxied through green bond issuance. With that, I would like to hand over to our third co-author, James, sir. Okay, I think James sir is having some connectivity issue, I think. So the conclusion of our paper is that we find that green bond funds enjoy higher valuation. And so can you continue, James, sir?
I'm really sorry, I got a network issue here. Sorry for that.
Yeah, please conclude.
So our study is having mainly three conclusions. Says that ceteris paribus, green bond firms enjoy a higher valuation compared to brown bond firms. So it's in line with the revisionist view that environment and economics can be achieved together. Also, green bond issuance firms are less prone to external shocks. It is reflected through the lower fall in the prices when the crisis was there, and may be attributed to lower selling pressure as well as higher investor confidence over firms that issue green bonds. It's also marked by higher resilience, which means that we could observe quick bounce back to pre-crisis or pre-COVID valuations. And also higher greenium that the firms or green bond issuing firms that they enjoy during normal times, it's much more during the crisis period, maybe attributed to the cushion against the disruptive shocks. Next slide. Our study is having three-pronged implications. From an investor's point of view, the results encourage them to create environment-friendly portfolio so that they can enjoy the benefit of a sustainable portfolio in terms of defense as well as resilience, especially when there is an external shock. The outputs of the study may be used by the managers, and it will encourage them to follow sustainable practices because it is valued positively by the investor community. It's very evident from the valuations and the bounce back. Also, policymakers and regulators can be educated by using the output from our study about the need of creating a balance between the stringency and support. There need to be a balance between the stringency and support while formulating the ESG policies.
Thank you, Dr. James. Now I request Dr. Panda, sir, to give his comment. Stop sharing.
Yeah. Thank you, authors. Anto Joseph, Garima Sisodia, and James. You have again taken a very emerging area on green bond, and we have seen like you have also got best paper in previous conferences. Your work was very good. I'll just list down my points, like the objectives you have said, like how the global presence of corporate bonds is green financing tool to facilitate sustainable practices of eco-friendly investing. And the study investigates the interviewing questions whether the companies that issue green bonds are valued more by investors or not, and further extends the analysis by exploring whether the green image of the companies helps to minimize the value erosion during a crisis and enhance the resilience of the stocks. So again, you have also examined the association between environmental commitments and farm value, and you have used COVID-19. That is a very good way of looking into, because that is the crisis period or the emergency period when market behaves differently. So the findings are like indicate that green bond funds are valued more by investors as compared to brown bond funds, and green bond issuance act as a strong signal of the firm's environmental commitment, and it is well recognized by investors. And maybe one of the possible reasons that you have mentioned are higher value of green bond funds may due to their ability to arrest value erosion during environmental shocks. So this green by definition is very good, but if you look into the size of this green bond market, even you have also mentioned it is 2% only in all over the world. And you have very nicely written the abstract. It is very up to the point. If you look into your objective of study, you have considered green bond and brown bond. But there is another category called blue bond. So in actually more innovative financial instruments are there in the fixed income securities as compared to your equity markets. There are n number of masala bond and bulldoze bond, samurai bond. We have n number of categories of green bond. Now you can categorize also you can consider the blue bond into consideration as well. And the cost of issue of green bond is very high. And are there any specific benefit to the issuer? Yes, issuer can claim that yes, they are doing green projects and they are saving the environment. But whether this green word can create any bubble in future, because we are more towards the word, but not towards the how the due diligence happens, how the firms are maintaining the objective of issuing the green bond. So that is one major area, although you have considered many countries company-wise analysis that takes a lots of time to analyze as well. And you have done that, that is very nicely you have done. This proceeds whether is used in a proper way or not. So does a green bond actually is doing activities of green or activities of brown? Now, why you have reviewed some of the ESG papers, you have not considered ESG scores or ESG parameters. You can say one of the parameters is environmental, but if you are reviewing ESG papers, you should include some ESG analysis, or else good to omit those ESG papers. You have done sufficient review, and you need to justify the signaling theory in your study. What is the role of that signaling theory in your study? So, some abbreviation like small things you have written like CBI 3-4 times initially in your paper, and after the 4th time you are writing the full form of CBI, that you just look after that. And the methods also, the value erosion and resilience, you have to justify more clearly. You've done a lots of analysis, but how it is relevant, what is the relevance of this value erosion and resilience. And the propensity score also, you have calculated, now the justification are required. And in your result, you have only considered the R square. The adjusted R square will be more significant as compared to R square. All of you are aware, just include that. And the diagnostic tests are missing in your study. Whether I have not gone through your appendix, but it is missing in your study. Now, in your conclusion, you are saying like results show that government stringent environmental policies can make it costlier for farm. But you have, in your analysis, have you considered this government policy? I am not saying that the countries that you have mentioned, you have not mentioned their policy or comparison of green bond policies of these countries that you have considered. That could have been done. Without that, your result is nothing to do, as per my understanding, to the policies. So how you are commenting on the policies, you need to justify. Okay. So yes, in your paper, we understand this working paper, but so much repetitions has happened. You can remove this section 2 of your paper, which is on green bond, corporate green bond market overview, because you have already mentioned that in the introduction, in the literature and the analysis part also you are mentioning something. So at least one sentence is repeated 4 to 5 times. So you just take care about that. That happens when you start working, and it requires lots of proofreading as well. and add recent literatures. You have added so many literatures. Few are there on 2020 and 2021, but more are there before COVID period. Since you have focused on the COVID period, you should focus on, you should do more review on COVID period. And the green bond market size is very small, that is 2% you have mentioned, but that you have mentioned at least 6 times or 4 to 5 times in your paper. That please take care about that. So the paper is very lengthy without like any specific reason you are putting so many things. So just summarize it. So it will be going to a category journal if you summarize and do that. Okay, thank you. Now you can. One more thing I will say, like
Sir, we are not able
India,
to hear you.
You are not able to hear me? Are you able to hear me? Anyone?
Yes,
Yes,
sir.
sir, you are audible.
Clearly audible.
Okay. So one more thing, say when you have considered other countries, you should also focus on India. Although SEBI has brought out with the green bond regulation in 2017, and we have few issues of green bond. You can look into our INX International Stock Market Stock Exchange. Many of the issues are green bond issues. Even SBI is the largest issuer. You can also look into the issuer who is issued based on SEBI regulations. The earlier issuer were issuing with World Bank regulations, and World Bank brought out this green bond in 2008 with the request of the investors. So institutional investor has requested. This is a very good innovative product, and which is there to safeguard the society, but more due diligence is required. Yes, now you can respond.
Yeah, Garima, Anto, James, if you have any comment on this.
Yes, sir. Actually, the comments are, very much accurate and, to the point. So we have, in fact, after doing this paper, I mean, we did a couple of presentations and we got the similar comments that, a paper is a bit lengthy and some.
Since it's a collaborative paper, I think everybody wants his points to be put and kept like that happened.
To an extent, yes, sir. So to an extent, that is also true. But anyway, we have worked on that. We have made it very focused. All the redundancy is removed. And all these points, we have taken a note of that, and definitely we will improve our paper with the valuable comments from your side.
From audience who are present online and offline.
Certainly, online questions, just say there are 3 chapters. Even one in Q&A also.
We have a question from Nikita Kedia.
No, I think this was for previous.
Previous.
Okay,
you can ask it from chat. Check from chat.
It will also answer.
No, that is for.
That's for the previous.
Yes.
Any questions from anyone here in the audience? If there are no questions, we can move on to the next presenter.
Thank you, Dr. James, Garima, and Anto.
Thank you, sir.
Thank you.
Thank you, sir. Thank you so much for giving us this opportunity. Thank you, sir.
Now we'll move on to the last presenter for this session, Chetna Rath or Dr. Malbika Dev. Okay, you're physically. Just make it full screen.
नेक्स्ट स्लाइड करके एक बार चेक कर लो. ओके फाइन. उसको ट्राई कर दो.
Introduce yourself and you can start.
So good afternoon, everyone. I am Chetna Rath. I am a qualified company secretary and also working as a senior research fellow in the Department of Commerce, Pondicherry University. I am co-authoring this paper with my research supervisor, Dr. Malbika there. We have often heard in the news that the rich gets richer and the poor gets poorer. How come 73% of the wealth of the nation is held by just 1% of the top-notch corporate personals in India? And how come those 1% be the chief executive officer and or managing director of those corporates? So whether the firm performance of those companies is aligned with the compensation paid to the executives, and what moderating role can the non-financial performance or the ESG factors, that is the environmental, social and governance factors, can play in determining the performance-based pay. So all these questions instigated me to go for the topic, the moderating role of greenhouse gas emissions and energy consumption disclosures in determining the performance-based CEO compensation. So like in this paper, I have only focused on the E factor, that is the environmental factor, because considering the entire thing will become very vast, so I've only focused on the environmental related factors. So this is my plan of presentation. So first I'll be discussing on the introduction, then I'll give a brief background along with the literature reviews. And then I'll move on to the objectives, data and methodology. I'll say why I have selected the particular model. I'll focus on the results, then the findings, and then what is the future scope along with the limitations. So as we all know that climate change possesses a very serious threat to the people and mankind around the world, and it has implications for the full enjoyment of human rights. But businesses are constantly pressurized to reduce their environmental impact to the community. So there is a new concept of sustainable compensation policies. So the logic behind this sustainable compensation policy is to focus on long-term sustainability, especially in case of ESG firms. And the concept is to reward the chief executive officers in these social responsibility firms with a higher pay, so that they are reluctant to engage themselves in environmentally harmful activities. The purpose of this paper is to explore the moderating role of environmental disclosure score in determining the effect of firm performance on CEO pay. So this is the diagrammatic scheme of our work. Here, the firm performance, the effect of firm performance is on CEO compensation, and ESG disclosure score, that is the environmental disclosure score, plays a moderating role here. And like I have taken two important proxies of environmental disclosure score. One is the energy consumption disclosure, and next one is the greenhouse gas emissions disclosure. So I like both energy consumption and greenhouse gas are showing the negative, like are negative. They have a negative impact reasonably also, and environmental disclosure has a positive impact. So now the literature review I have classified into two sets of hypotheses or two sets of contrasting hypothesis. Okay, the first one is focusing on CEO compensation and firm performance. So when we talk about this factor, it has two contrasting hypotheses. The first one is the overinvestment hypothesis, which is derived from the agency theory. So this states that when the CEOs are conducting more and more CSR activities, that even though helps them in earning a higher reputation, but it decreases the firm performance. The second one is the conflict resolution hypothesis, which states that, which is derived from the stakeholder theory, that states that the CEOs carry out more and more CSR activities that is used to benefit the people, but it reduces the firm performance because most of the amount is channelized towards betterment of the community. That's why they get less CEO pay and increases the firm, but more firm performance is derived. The second one is focusing on environmental reporting and disclosures and firm performance. Here again, we have two sets of hypotheses. The first one is the halo effect, which states that a positive impression is created by social responsibility, which is able to reduce the negative effect created by emissions or energy use. That would lead to a better firm performance. The second one is the fallen angel effect, which states that even though there is a higher positive effect, that will create a disillusion in the minds, and that won't be able to reduce the negative harm or harmful effect of emissions, that which would ultimately lead to adverse firm value. So coming to our objective, the first objective is to ascertain the role of ESG disclosure scores in determining the effect of firm performance on remuneration paid, as I had discussed in the diagram earlier. The second one is whether the mediating role of emissions and energy use is able to moderate the performance-based CO pay. And third one is to find out whether the negative impact of emissions and energy use is intensified or alleviated by the positive influence of ESG. So this is done by taking an interaction effect concept. And the last one, we have also taken a set of environmental oriented policies. So we have taken 5 important environmental oriented policies in our study as a dummy variable, and we have the data and methodology, we have only focused on the Indian context, and we have taken the NSE Nifty 100 ESG index. So NSE comes out with a Nifty 100 ESG index, which contains the top 100 companies based on the market capitalization as well as their inclination towards carrying out ESG like ESG practices. So the study is post the study period is post the implementation of Companies Act 2013, that is 14 to 19. And we have taken data, all the financial data we have collected from CMI Probase database, and all the ESG related data we have collected from Bloomberg database, which is again a quite reliable database when it comes to the corporate finance domain. The final sample is a balanced panel of 67 firms for 6 years, and that results to 402 firm year observations. The methodology we have applied is a PCSE model, that is the Price-Winston regression model. And for robustness, we have also used the 2-step system GMM. So this is the baseline generic regression model, which again, as I've explained you, the dependent variable is the log of CEO pay. And in independent variable, we have ESG disclosure scores, emissions index, energy use index, and we have the interaction of ESG with emissions and ESG with energy use. So how we have computed this emission index and energy use index? So we have self-computed it by this formula, which again we have derived from Sharma et al. 2020. So the formula is like the total number of items actually reported by the total number of items ought to be reported. So if the companies had to report 10 items and they have reported only 3 items, so the index will be like 3 by 10 into 100. So that's how we have computed the GHG emissions index as well as the energy use index. So now coming on, like why did I choose this PCSE model? So as I am having a panel data, so the generic, the formula will be like, I have to take either a fixed effect model or a random effect model. So I applied the Hausman test, and the Hausman test was in favor of fixed effect model. So after that, I have done further diagnostic with that, and our model shows the presence of cross-sectional dependence and heteroscedasticity. That's why in order to eradicate all these problems, we have used the panel PCSE model. So the PCSE model, it was given by Beck and Kaz in the year 1995, which is a robust standard error, which produces more robust standard errors when disturbances are heteroscedastic, autocorrelated, and contemporaneous correlated. So as we had all these problems, that's why in order to eradicate, we have used this model. So these are the variables. CEO compensation, we have taken total, the sum of the total pay. That includes the basic salary, bonus component, PF, retirement benefits, etc. The ESG scores, we have directly taken that from the Bloomberg database. Emissions index and energy use, as I told, we have self-computed it by using this formula. Apart from that, the firm performance measures, we have taken both the accounting-based as well as the market-based performance measure. So ROE and ROE are basically the accounting-based measures, and Tobin skew and returns are the market-based measures. So that's how we have taken, and we have also used certain control variables, that is the firm size, leverage, ownership structure. Again, a dummy variable which takes a 1 if it's a group firm, or 0 if it's a standalone firm, and market to book, the market capitalization or market to book ratio. Then, as I was telling, we have taken 5 policy measures. These are the 5 policies: energy efficiency policy, environmental quality, policy, GRI, compliance criteria policy, emission reduction policy, and climate change policy. So the logic is simple. If they are reporting all these, then it's a 1, otherwise it's a 0. Then this is our model and the results of the model. So I've only shown them like the PCSU model results. I've not focused on the robustness because of paucity of time. So the results of this model, like these are the 4 firm performance measures. So in the 4 firm performance measures, they are mostly showing a support to the conflict resolution hypothesis, that is the market-based measures and firm performance measures, except ROE. All the like Tobin's Q, ROA and returns are showing negative relationship with the pay. And here coming to the ownership structure, ownership is showing a highly significant perfect positive in all the models. Then these are key variable of interest, key explanatory variable of interest. Here we can see that ESG disclosure score is showing a highly positive significance in all the models. But when we are considering the emissions index, it is showing a negative relationship. And the same is with the energy use and also the interaction effect. So all the 4 models, for the 4 models are showing a highly, negative impact on as a moderator. So that's what are the inferences that we draw? We draw that the ESG disclosure is highly positive significance, which means that firms having higher ESG disclosure score are ready to pay more to their executives. This is justifiable because more disclosures help in instilling a confidence in the minds of stakeholders and thereby raising the remuneration numbers. But at the same time, emissions as well as energy use shows a negative impact, and also the interaction effect is negative, which means that the positive influence of ESG is unable to reinforce or reduce the harmful negative impact or intensity of the GHG emissions or excess energy use. So ownership structure, all climate change policies also have a positive impact in our model. So we would like to conclude by saying that ESG disclosure score has a high moderating impact in determining the performance-based pay, and it is very important for ESG disclosure and transparency, and to increase the reporting of emissions or energy use. And will also the policymakers also need to take care of the negative impact of emissions or energy use while taking important key strategic decisions, as it would reduce the positive impact of ESG. So they have to keep a check so that the beneficial actions are not waved off owing to negative impressions in the minds of stakeholders. The last slide is the limitation and scope, which we have only taken the total of CEO remuneration, but in most of the Western studies, we'll find that they have distinguished between cash-based pay and equity-based pay of CEOs, which we have not considered, considering the limited data that we are having in case of Indian context. So the data period ranges from 2014 onwards. We can do a pre-post analysis prior to Companies Act and post Companies Act. So that can also be done. So the study is confined to India only. Because like if we are taking a cross-country study, then we have to consider corporate laws of different countries, which is not similar as in case of corporate governance studies. So that can also be thought of. Then we are only taking the environmental indicators. As I told, we can also consider other social as well as governance indicators. The work is quantitative in nature, and it is based on secondary sources of data collection. So a direct interview or questionnaire method with the CEOs would be more appropriate in this case. So with this, I would like to conclude. Thank you everyone.
Chetna. I request Dr. Panda sir to give his comment. You can have a seat. Close first presentation.
Yes. So sorry for some of the technical glitches. So thank you, Chetna and Professor Dev. You have done a very again effective subject like the greenhouse and the carbon consumptions. So energy consumptions in determining the performance of CO2 compensation. The summary you have already done, like the ESG disclosure in determining the effect of farm performance on CO's compensation. Further, you have also tested the whether the negative effect of greenhouse gas emissions and energy use are alleviated or exacerbated in the presence of ESG score. And the finding was highlighted on the moderating role of environmental disclosure in assessing the effect of farm performance on CO's pay, especially in emerging economies. So, so this has also added a value to claim that in addition to disclosing ESG activities, the business must be quite alert with their carbon emissions and energy oversight. So the objective was very well organized because this is also concern for environmental, this is also concern for corporates and regulators. That's how Bloomberg first has started creating the ESG score, which was not having like a well-defined, they have not disclosed the score criteria, how they are scoring. But later on, many organizations are also scoring, and SEBI is coming out with the framework for this ESG. Maybe that will give you good food for thought for further research, because once that SEBI framework will be built up, then further study can be extended with SEBI scores or based on SEBI scores. We have considered Nifty 100 ESG index companies from 2014 to 19. Now you can, you are silent about COVID period. You can consider now extend your study for the COVID period. During that, how this CO compensation or greenhouse gas emissions has impacted. Then on the methodological part, your models are adequate. Many studies are considering only panel regression, fixed effect, and random effect, but you have employed the panel corrected standard error models and GMM model also for the robustness test. Again, you have done the interaction variables. That is more important. That is one very good thing. Now, when we do interaction, the robustness again increases instead of considering one single variables. This study can be extended towards the once the SEBI framework comes out. So, thank you.
Thank you, Dr. Panda, sir. Any questions from the audience?
Yeah, I have one question.
Yes, sir. Please.
Yeah. Actually, you said first title itself.
Yeah. Yeah, the title is lengthy. I just missed. The title is so lengthy, you should reduce it.
Please show the title. Windows duplicate. First slide.
Just a minute.
Yeah, go to first slide.
This one.
Regression model. Yeah.
This one.
Regression. Formula better. Regression.
Oh, that model, you know.
Now take them to dependent variables CEO compensation. We are capturing that.
CEO compensation. It is the total sum of all the components of pay, CEO pay. Yeah, like MDs or CEOs of top companies, we have taken the salary and we have like added all the components, like whether total salary, I mean the total salary of all the CEOs. We have taken log of that.
Okay. So the salary or compensation might be influenced by some other factors other than the variables that you have mentioned. How do you control it?
But we have done the endogeneity test like that. Whatever like specific firm specific controls we are able to take, we have taken like the firm size, leverage and all. Apart from that, that's what we have controlled for endogeneity also. We have done a lot of robustness check and to see what's the impact. I think it's not possible for us to take all the controls, but whatever is possible we have taken and we have controlled for endogeneity using the robust model.
First thing is not mentioned in the equation.
Pardon?
It is not mentioned in the equation. So
No equation, yeah, like that's the this one, a JIT, a ZIT, I mean the vector of all other related control variables. So that's a group. I mean, I've just given as a this thing, and here, yeah, let's say here we have taken like firm specific controls. So these are the 4 controls that important controls that we have considered. So that as a group, like as a whole, we have mentioned as JIT. I mean, YIT is the firm performance measure, and ZIT is the other related controls. So we have not taken individually, but just we have shown.
Any other question?
I have one. Yeah. So like when you have taken the CEO compensation based on the like greenhouse gas emissions, but have you taken them industry wise, because the IT industries have comparatively lower emissions, and then you will see the oil and gas sector?
No,
So,
industry wise classification I have not done. I think I can take it up for future study, but I have controlled it like the dummy, industry dummy. Dummy and controlled it, but I have not classified it industry wise. I've taken just the index, no, so all the 100 companies. So whatever 100 companies and their compensation, CEO compensation, industry-wise classification I have not.
some industries still have more emissions and some will.
But that's why I've taken the log. So log it will equate it, generally.
Thank you very much.
Yeah. Just in addition to that one, have you segregated the whole data set based on a state ownership and private ownership?
No, ownership group firm and standalone firm I've taken as a dummy. I've not segregated. Like I mean, in this work I have not done. In my research, original research work I have done. But here I have not shown.
which company could not be from the group?
So mostly the government ones, sir. Government companies, they don't belong to a group. Like Tata and all, they belong to a particular group. I mean, all the industries under that, but like ONGC and all, like
Public sector.
yeah, public sector, they don't belong to a group. It's very few, but they are not group. They're standard.
Any other questions?
Thank you.
Thank you. Thank you.
So I would like to thank all the presenters who are present especially Dr. Panda sir for the extensive reading and then making detailed comment, starting from the conceptualization to the length of and the methodology which has been used. Normally it's happened that whenever we write a paper, we always think that we are on the right side. And I think this kind of presentation has different kind of views, different kind of sides are there. So research for me is a purification process. So whenever you present to more people, I think you get more correct on the correct path, because generally we have some pre-notions in the mind when we start doing research. So I think it helps researcher also to understand our own perspective, how it is correct. And then from others' perspective, how we look at research. That is more important. So I would like to congratulate those who are being shortlisted and allowed to present in physical mode and in virtual mode also. And all the students who are here basically for coordinating this event, because we are on physical. There's something is digital and something is physical. And on the patient audience who spend a lot of time in listening to the research paper. So thank you very much.